IFRS 15 revenue from contracts with customers is the product of a major joint project between the ISB and US Financial Accounting Standard Board. The previous requirements of IFRS and US GAAP were not harmonized and often resulted in different accounting treatments for economically similar transactions. In response, the boards have developed new, fully converged requirements for the recognitions of revenue under both IFRS and US GAAP. According to IFRS criteria, for revenue to be recognized, the following conditions must be satisfied. First, the rights and rewards of ownership have been transferred from the seller to the buyer. Second, the seller loses control over the goods sold. Third, the collection of payment from goods or services is reasonably assured. And lastly, the amount and cost of revenue can be reasonably measured. Conditions 1 and 2 are referred to as performance. With regards to it, performance occurs when the seller has done what is to be expected to be entitled to payment. Conditions 3 referred to as collectability, as the seller must have a reasonable expectation that he or she will be paid for the performance. The last two conditions are referred to as measurability. Due to matching principle, the seller must be able to match the revenues to the expenses. So when and how to recognize revenue? In 2014, there was a huge change in IFRS related to revenue recognition guidance, because before the change, the guidance on revenues will spread all over the standards and there are various interpretations too. For example, we had IS 18, which is revenue, IS 11, which is construction contracts, IFRIC 15, real estate sales, IFRIC 13, which is customer loyalty programs, IFRIC 18, SIC 31, transfer assets from customers, advertising barter transactions. This interpretation all guiding us when and how to recognize revenue at various circumstances, and it was quite difficult to identify what standard to choose in your specific situation, and also it was something conflicting and confusing too. So to come out of this unfavorable situation, ISB worked with American Standard Setting Body, FASB, and come up with the totally new revenue recognition standard, which is IFRS 15, revenue from contracts with customers, when all previous guidance was superseded. In common with other recently issued IFRS 15 includes comprehensive application guidance and illustrative examples, together with a detailed section which sets out how the ISB reached its decisions about the new requirements. So what is the impact? Entities affected will need to reassess their revenue recognition policies and may need to revise them. The timing and amount of revenue recognized may not change for single contracts or a single deliverable, but most complex arrangements will be affected to some extent. And IFRS 15 requires more and different disclosures. The new standard also introduced an overall disclosure objective together with significantly enhanced disclosure requirements for revenue recognition. These are accompanied by an explicit statement that immaterial information does not need to be disclosed, and that the disclosure requirements should not be used as a checklist. In practice, even if the timing and profile of revenue recognition did not change, new and modified processes might have been needed in order to obtain the necessary information. IFRS 15 applies to all contracts with customers with some exceptions. Here is the list of types of transactions where you look to other standards for guidance, so not to IFRS 15. The IFRS 16 leases contracts, IFRS 17 insurance contracts, and financial instruments and other contractual right obligations within the scope of IFRS 9, IFRS 10, 11, IS 27, and 28. In addition, we do not apply IFRS 15 to barter transactions if they're done between companies within the same business. For example, sometimes two companies trade oil or other commodities or swap them in order to meet the demand. So let me stress here that we apply IFRS 15 only to contract with customers, not with some other party. For example, we do not apply IFRS 15 with contracts with collaborating parties. Pharmaceutical company is, I think, one of the examples because they have contracts to where they cooperate on the development of certain drug. And we must assess here if they are act as a customer or collaboration. The core principle underlying the new model is that an entity should recognize revenue in a manner that depicts the pattern of transfer of goods and services. The amount recognized should reflect the amount to which the entity expects to be entitled in exchange for those goods and services. In order to meet the core principle, IFRS 15 adopts a 5-step model. The absolutely essential thing what IFRS 15 does, that it introduces 5-step model for revenue recognition. If you want to determine how and when to account for revenue in your particular situation or transaction, all we need to do is go through this model. So let's briefly take a look and then we will touch each step of it. Step 1 is identify the contracts with customers. The contract is a certain agreement between two or more parties and it creates enforceable rights and obligations. It can be in both written or oral form. However, it must be enforceable and this will depend on the legislation in the particular country. There are some transactions that is very simple and straightforward. Like for instance, when we go to the shop and buy something, we are simply entering into some sort of a contract. But on the other hand, there can be quite complex contracts for some transactions. IFRS 15 also describes the attributes for each contract, and now there could be two basic issues related to the identification of a contract. First issue would be combination of contract. Sometimes you will have two or more separate contracts going on, and they might need to be accounted for as one because they are interrelated. So there are rules when you need to take these separate contracts and account for them as for one contract after all substance over form applies. Another complication with identifying the contract can be contract modifications. In other words, what happens if you modify, amend, or change existing contracts either in its price or scope, or the things you need to deliver under the contract. You may have to account for modification as for a separate contract or as for some catch-up adjustment, or some combination depending on what modification is about. Another step in the revenue recognition model in IFRS 15 is to identify the performance obligations in the contract. It is a certain promise in the contract to deliver to the customer either some good or service, or a bundle of goods and services that is distinct, or a series of goods and services that are almost the same. For example, when you sign up for monthly cleaning services or for monthly accounting services, and these services are basically the same each month. So, a contract usually explicitly states the goods and services that should be transferred to a customer, so we consider it as explicit performance obligations. But sometimes there could be also be implicit performance obligations that are implied by something. For example, by entities' customary business practices, some guarantees that company usually provides to all customers without explicitly saying that in the contract. So, when there is no transfer of anything to the customer, then there is no performance of obligation. For instance, when some company must buy new IT system in order to fulfill the contract, and it must perform some setup activities, these activities transfers nothing to the customers. Therefore, there are no performance of obligation. So here in the second step, the crucial thing is to assess whether the performance of obligations should be treated separately for accounting purposes, or in other words, whether they are distinct. For better understanding, take a look at an illustrative example for step 1 and 2. A telecom entity, Telstar for example, entered into a contract with a customer on July 1, 2022. The customer subscribed for a 12-month contract and in return received free handset from Telstar. The customer will pay a monthly fee of 200 as per the contract and receive the handset immediately after the contract has been signed. Telstar sells the exact for 140 per month. Telstar has a December 31, 2022 year end. Now, when we look into the illustrative, a customer will receive free handset that has a monthly subscription which will be for 12-month period. When we will look at our 5-step model, our first step we need to identify if there is a contract. Yes, there is a contract. In this illustrative, they indicated to us that they have been entered into a contract, therefore we comply with step 1. Step 2, we need to identify the performance obligation. Now, what is performance obligation? Remember that this is a promise by the entity to provide distinct goods or services to our customers. In this illustrative, our performance obligation will be the handset and 2-month subscription plan.
And now, let's continue to the third step in the revenue recognition model, which is the determination of the transaction price. So, ano ba muna yung tinatawag o sinasabi natin na transaction price? Under IFRS 15, the transaction price is defined as the amount of consideration an entity expects to be entitled to in exchange for the goods or services promised under a contract. Meaning, the transaction price is the amount of consideration an entity expects to receive for the transfer of goods or services to the customer. The amount can be fixed, variable, or a combination of both. Transaction price is allocated or yung price na inailalaan sa atin as we give products or as we render services to our customers, which we all know is identified to the performance obligations in the contract. And always remember that these amounts are what we should recognize as revenue when the performance obligation is fulfilled. This transaction price excludes any amounts on future options for a contract that will eventually collect on behalf of third parties, like sales tax for example. For the purpose of determining the transaction price, it should be assumed that the goods or services will be transferred to the customer as promised in accordance with the existing contract and that there will be no cancellation, renewal, or a modification. So, in the determination of the transaction price, we assume or suppose na yung goods or services na ibibigay o ipe-perform natin ay hindi na mababago o makakancel as stated in the contract. The transaction price is not adjusted for the effects of the customer's credit risk, but it is adjusted if the entity, just like for instance, its customary business practices like adjustment for discounts, rebates, and bonuses resulted in the creation of a valid expectation that will only enforce its rights for only a portion of the contract price. When dealing with a fixed amount to be received, transaction price is easy to determine. However, may ilang instances or situations which require more judgment. The estimate of the transaction price will be affected by the nature, timing, and the amount of consideration promised by a customer. An entity must consider the effect all of the following factors when determining the transaction price. The factors that may affect the transaction price includes variable consideration, time value of money, non-cash consideration, and the consideration payable to the customer. Variable consideration. Variable consideration is included in the transaction price when it is highly probable that a significant reversal of revenue or decrease on revenue will not occur. When there is a substantial probability that a significant revenue reversal or reduction will not occur, variable consideration is reflected in the transaction price. So, in determining the transaction price, you should consider the effects of the variable consideration. If the amount of consideration is subject to change due to the timing or other performance factors, then it is considered variable. Variable consideration can arise for a wide range of reasons, including discounts, rebates, refunds, credits, incentives, performance bonuses, penalties, or other similar items. If there is any potential variation in the amount that the vendor would receive in return for its performance, then the provisions in IFRS 15 dealing with variable consideration applies. Under prior IFRS, an entity could only recognize revenue if it could only reliably estimate the amount, or the uncertainty over the outcome may prohibit revenue recognition. However, on the new IFRS 15, the constraints sets a ceiling, meaning they just limiting rather than prohibiting revenue recognition. Let us take a look at this illustration An example of a penalty that gives rise to a variable consideration. An entity enters into a contract with a customer to build an asset for 1 million. In addition, the terms of the contract include a penalty of 100,000 if the construction is not completed within the 3 months of a date specified in the contract. The entity concludes that the consideration promised in the contract includes a fixed amount of 900,000 and a variable amount of 100,000 arising from the penalty. An entity should recognize both the likelihood and the magnitude of the revenue reversal and for all of the other types of variable consideration. Variable consideration should only be included in the transaction price to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty associated with the variable consideration is subsequently resolved. When the consideration promised in a contract with a customer includes a variable amount, a vendor estimates the amount of consideration to which it expects to entitle to in exchange for the transfer of a promised goods or services. These are the two possible methods which we can be used and which are required to be applied consistently throughout the term of each contract. The first method for estimating variable consideration is the expected value method. These may be appropriate when the entity has a large number of contracts with similar characteristics and it is calculated as the sum of the probability weighted amounts in a range of possible consideration amounts. Illustration. On January 1, 20X1, a vendor enters into a contract with a customer to build an item of specialized equipment for delivery on March 31, 20X1. The amount of consideration specialized in the contract is 2 million, but that amount will be increased or decreased by 10,000 for each day that the actual delivery date is either before or after March 31, 20X1. In determining the transaction price, the vendor considers the approach that will better predict the amount of consideration that it will be entitled to, and determines that the expected value method is appropriate approach. This is because the range of possible outcomes. The next one is the most likely amount. This may be appropriate when a contract has only two possible outcomes. It is the single most likely amount in the range of possible consideration amounts. Illustration. A vendor enters into a contract with a customer to construct a building for 1 million. The terms of the contract include a penalty of 100,000 if the building has not completed by a specified date. In determining the transaction price, the vendor considers the approach that will better predict the amount of consideration that it will ultimately be entitled to. It concludes that the most likely amount method is the appropriate approach. This is because there are only two possible outcomes. Either the penalty will be applied, wherein they will only receive 900,000, or it will not be applied such that it will receive the whole 1 million pesos. The method an entity uses to estimate variable consideration is not a free choice. An entity should use whichever method will better predict the amount of consideration to which it will become entitled. When an amount has only two possible outcomes, it will often be appropriate to estimate the variable consideration by using a method based on the most likely amount. When the entity has a large number of contracts with similar characteristics, and the outcome for each contract is independent of the others, the expected value method may better predict the overall outcome for the contract in aggregate. This will be true even with each individual contract has only two possible outcomes. Example is a sale with the right of return. This is because an entity will often have a better information about the probabilities of various outcomes when there are a large number of similar transactions. It is important, however, to consider carefully whether the outcome for each contract is truly independent of the others. For example, if the outcome is binary, but it is determined by the occurrence or non-occurrence of the same event for all of the contracts, like the variable amount will be received either for all of the contracts or for none of them, the expected value is unlikely to be a good predictor of the overall outcome, and the entity may need to use the most likely amount method to estimate the variable considerations in the contract. The next factor that may affect the transaction price is the time value of money. Here, the consideration should be adjusted for the time value of money if the contract has a significant financing component. Revenue is measured based on the cash selling price. As a result, and the entity must recognize revenue at the amount that would have been paid in cash by the customer at the period the goods or services were transferred to them. Financing components in the transaction price, therefore, considers the time value of money. This occurs when the timing between the receipt of the consideration and the transferring of goods or services is more than 1 year. However, if the contract period is less than 1 year, the entity can disregard the time value of money. The next factor is the non-cash consideration, which should be measured at its fair value. If you receive payment in a non-cash form, then the fair value of the non-cash consideration or payment is included in the transaction price. When the fair value of the non-cash consideration cannot be reasonably estimated, the consideration is measured indirectly by reference to the standalone selling price of the goods or services promised to the customer in exchange for the consideration. Meaning, when a customer promises consideration in a form other than cash, an entity measures the non-cash consideration at its fair value. But if the fair value cannot be determined, the standalone selling price of the goods or services is used. Standalone selling price will be discussed in the succeeding step. Take a look at this illustration showing entitlement to non-cash consideration. An entity enters into a contract with a customer to provide a weekly service for 1 year. The contract is signed on January 1, 20X1 and work begins immediately. The entity concludes that the service is a single performance obligation in accordance with the IFRS 15, paragraph 22B. This is because the entity is providing a series of distinct services that are substantially the same and have the same pattern of transfer, like the services transferred to the customer over time and the use of same method to measure progress, that is a time-based measure of a progress. In exchange for the service, the customer promises 100 shares of its common stock per week of service. The terms in the contract require that the share must be paid upon the successful completion of each week of service. The entity measures its progress towards complete satisfaction of the performance obligation at each week of the service is complete. To determine the transaction price and the amount of revenue to be recognized, the entity measures the fair value of 100 shares that are received upon completion of each weekly service. The entity does not reflect any subsequent changes in the fair value of the shares received in the revenue. Dahil entitled ng non-cash consideration an entity, which in this example is in the form of common stock, dito kailangan i-reflect ng entity ang price ng 100 shares on the fair value pagkatapos makompleto ang weekly service sa customer. At dahil magkakaroon ng changes in the price of the share that the entity is entitled to receive, hindi pwedeng mabago ang price ng share ng mga previous weeks kung tumaas o bumaba man ito. Always remember that non-cash consideration should be measured at its fair value. And the last factor that may affect the transaction price is the consideration payable to the customer. Here, we should determine if the consideration payable to the customer may result in a reduction of the transaction price. Consideration payable to a customer also includes credit or other terms like coupon and vouchers that can be applied against the amount owed to the entity. An entity should account for the consideration payable to a customer as a reduction of the transaction price and, therefore, of revenue unless the payment to the customer is in exchange for a distinct goods or service. If the consideration payable to a customer includes a variable amount, the transaction price is estimated in accordance with the IFRS 15. At times where the entity will be required to make a payment to the customer, such as a rebate, vouchers, and coupons, this payment reduces the transaction price as well as the revenue recognized. Here is an example about consideration payable to a customer. An entity that manufactures consumer goods enter into a one-year contract to sell goods to a customer that is a global chain of retail stores. The customer commits to buy at least 15 million of products during the year. The contract also requires the entity to make a refundable payment of 1.5 million to the customer at the inception or at the establishment of the contract. The 1.5 million payment will compensate the customer with the changes it needs to make to its shelving to accommodate the entity's product. The 1.5 million non-refundable payment is gagamitin ng customer in the organization or shelving ng product na bibili niya sa entity. Under the requirement of IFRS, paragraph 1570 to 72, hindi ito makukonsider as an exchange on goods dahil wala naman control or any rights ang entity sa product on shelves ni customer. Pero, the 1.5 million payment ay considered reduction sa transaction price, and that reduction is only accounted at the time the entity recognizes revenue for the transfer of goods. For instance, nag-transfer na ng goods ang entity sa customer. Dito na magaganap ang reduction sa transaction price with the amount of 10 centavos per goods. Nakuha ito by dividing the 1.5 million payment with the 15 million cost of products for the year. As a recap, transaction price is the amount to which an entity is expected to be entitled to for transferring goods or services. At meron tayong 4 factors that may affect the transaction price. First is the variable consideration, which for example are performance bonuses and penalties, incentives, right of returns, and discounts. We also have the time value of money, which we have factors to consider, like difference between consideration promise and the cash selling price, expected length of time between transfer of deliverable and payment where if the contract period is less than 1 year. The entity can disregard the time value of money or practical measurement is advisable, and also the prevailing market interest rates. The next factor is the non-cash consideration, like share consideration, material equipment, labor, and the contribution of assets from the customer for the purpose of contract being met, where the entity gains control of those assets. And lastly, the consideration payable to the customer, which includes coupons, vouchers, volume rebates, and shelf space payments. And now, let's move on to the step 4 in the revenue recognition model, which is the allocation of the transaction price to the performance obligations. Allocate the transaction price comes into play when a contract contains more than one performance obligation. The seller should allocate the amount of the selling price to each performance obligation based on its relative standalone selling price. Having determined the transaction price of the contract in step 3, it is then necessary to allocate the transaction price to each of the performance obligations. The objective is to allocate an amount to each performance obligation that reflect the consideration to which a vendor expects to be entitled in exchange for transferring the distinct goods or services to the customer. The starting point for the allocation is to determine the standalone selling price of each of those performance obligations. Under IFRS 15, an entity allocates a contract's transaction price to each separate performance obligation within that contract on a relative standalone selling price basis at the contract inception or in the time of the establishment of the contract. IFRS 15 defines a standalone selling price as the price at which an entity would sell a promised goods or service separately to a customer. The best evidence of the standalone selling price is the observable price of a good or service when it is sold separately in similar circumstances and to similar customers. A contractually stated price or a list price of a good or service may be the standalone selling price. Although a contractually stated price or a list price for goods or service may represent the standalone selling price, this will not always be the case. For example, a vendor might typically grant discount from its list prices, or it may not sell the distinct goods or service separately from the others. When a standalone selling price is not directly observable, it is estimated. The objective is to determine the amount of consideration that the vendor expects to be entitled in return for the goods or service. This is achieved by using all available information, including market conditions, vendor-specific factors, and information about the customer or class of customers. In all cases, the use of observable inputs is required to maximize to the extent possible. IFRS 15 suggests but does not require the following three methods as suitable for estimating the standalone selling price. Meaning, if the standalone selling price is not directly observable, the entity must estimate such price by using the following methods. First is the adjusted market assessment approach. Here, the entity may refer to prices from competitors for similar goods or service adjusted for specific cost plus margin. This method in estimating the standalone selling price is done by evaluating the market in which it sells goods or services. The entity estimates the price that the customer in that market would be willing to pay for those goods or services. This approach may also include referring to price of the competitors for similar goods or services and adjusting those prices as necessary to reflect the entity's costs and margins. The second method is the expected cost plus margin approach. Here, the entity may forecast expected costs to satisfy the performance obligation adjusted for an appropriate margin or profit. Here, by the phrase itself, expected cost plus margin happens by forecasting the expected cost of satisfying a performance obligation and then adding an appropriate margin for that goods or service for a profit. And the last method in estimating standalone selling price is the residual approach. The standalone selling price is the difference between the total transaction price and the sum of the observable standalone selling prices of other goods and services in the contract. In this approach, we deduct the observable standalone selling prices that are available for other goods and services to be supplied from the total contract price. However, the use of this approach is restricted to those goods and services for which there is a wide range of selling prices, meaning that these cannot be observed from the past transaction or other observable evidence, or in some circumstances in which the selling price is uncertain because no selling price has been set for the goods or services and it has not previously been sold on a standalone basis. Always remember that this approach can only be used when either the selling price of the goods or service is uncertain. The step number 4 is to allocate the transaction price to the individual performance obligations in the contract. To better understand how allocation of transaction price happens, let us take a look at this illustration. Halimbawa, mahilig ka o collector ka ng mga basketball shoes at nakita mo yung special promotion na to. Sinasabi sa sale na kapag binili mo yung basketball shoes for 1,000 pesos, you will also get a free basketball socks. Pero in the accounting point of view, the shop, the Nike for example, has two performance obligations, yung shoes at yung socks. At yung transaction price is yung 1,000 pesos na babayaran mo. Which, sinabi natin sa step 3 na the transaction price is the amount that an entity is entitled to. However, how does the shop recognize the revenue? Under IFRS 15, hindi mo pwedeng i-recognize yung 1,000 para lamang sa shoes at 0 para sa socks. Instead, dito na papasok yung step number 4. You must allocate the 1,000 pesos transaction price to the both shoes and socks, and that is the point of this step. In general, you would do this in proportion to the relative standalone selling prices, and there are some exceptions to this rule. So, the standalone selling price is basically the price at which the shop would sell the shoes and sock if sold separately. Let us say that 1,000 for shoes and 200 for socks. We are pertaining to the standalone selling price here, yung price na mabebenta siya ng Nike ng magkahiwalay. So, in this example, we have a total of 1,200 standalone selling price. And we need to allocate the 1,000 na ibabayad mo based on the relative price na 1,200. So, for the basketball shoes, we use the standalone selling price of shoes na 1,000 divided by the total standalone selling price na 1,200 and multiply that with the transaction price of 1,000. So we get the 833 pesos allocated to the shoes. And for the socks, it's the same formula. The standalone selling price of socks na 200 divided by the total standalone selling price na 1,200 multiplied by the transaction price na 1,000, and we get the 167 pesos allocated to the stocks. With that, nahati na natin yung 1,000 na transaction price to the two performance obligation. So why does it really matter? It doesn't really matter that much when the shop delivers shoes and socks at the same time, because revenue is recognized at the same time. Pero it has something to do with our fifth step, which we will check out soon. Halimbawa, maraming nag-avail ng promotion sale at the shop runs out of free socks. Naubusan sila ng medyas. Nagpunta ka doon yung day 1 at nagbayad ka ng 1,000. But you will get only the shoes. And the Nike shop tells you na bumalik next day para makuha yung free socks. So pumunta ka kinabukasan and the socks are delivered then. Since the revenue can be recognized only when the performance obligation is satisfied, or in this case, goods delivered to the customer, yes, the shop would get 1,000 in cash on day 1, but it can only account 833 in revenue on day 1 para sa shoes. But yung natitirang 167 is on day 2, when it gives the socks to you. So, ginagawa natin itong allocation para sa precise timing ng revenue recognition. The final step in the revenue recognition model is to recognize revenue when or as an entity satisfies performance obligations. Under IFRS 15, an entity recognizes revenue when or as the entity satisfies a performance obligation by transferring control of a good or service to a customer. Having allocated in step 4 transaction price to the performance obligation, it is then necessary to determine when the revenue allocated to each performance obligation should be recognized. A vendor recognizes revenue when or as the goods or services are transferred to a customer. A vendor satisfies a performance obligation, that is, it fulfills each promise to the customer by transferring control of the promised goods or services underlying that performance obligation to the customer. A transfer occurs when the customer obtains control of the goods or service, meaning an entity should be recognized revenue when or as the entity satisfies a performance obligation, and it is satisfied when the promised goods or service to a customer is delivered, and that happens at the time or at the moment when the control of that goods or service is transferred, wherein the amount of the performance obligation is also the amount of the revenue. But what is control? And when we can say that the customer obtained the control over an asset? Control of an asset refers to the ability to direct the use of the asset and obtain substantially all of the benefits from the asset. And a customer obtains control of an asset, either be a good or service, when it can direct the use and obtain substantially all the remaining benefits from it. Control includes the ability to prevent other entities from directing the use of and obtaining the benefits from an asset. The benefits of an asset are the potential cash flow that can be obtained directly or indirectly from the asset in many ways. Here are the indicators that control had passed the customer if they has first, a present obligation to pay, physical possession of the asset, legal title, risks and rewards of ownership, and once the asset has accepted. For each performance obligation, a vendor determines at the formation of the contract whether control is transferred over time or at a point in time. If it is determined that the vendor does not satisfy a performance obligation over time, the performance obligation is deemed to be satisfied at a point in time. The following factors would indicate revenue recognition at a point in time. Letter A, the entity has the right to receive payment for the asset and for which the customer is obliged to pay. The entity has a present right to payment for the asset if a customer is presently obliged to pay for an asset. This may indicate that the customer has obtained ability to the direct use of and obtain substantially all of the remaining benefits from the asset in exchange. Letter B, the customer has the legal title to the asset. Legal title may indicate which party to a contract has the ability to direct the use of and obtain substantially all of the remaining benefits from an asset or the restricted access of other entities to those benefits. Therefore, the transfer of the legal title of an asset may indicate that the customer has obtained the control of the asset. However, if an entity retains the legal title solely as protection against the customer's failure to pay, those rights of the entity would not preclude the customer from obtaining control of an asset. Letter C. The entity has transferred physical possession of the asset to the customer. The customer's physical possession of an asset may indicate that the customer has the ability to direct the use of and obtain substantially all of the remaining benefits from the asset or to restrict the access of other entities to those benefits. However, physical possession may not always coincide with the control of an asset. For example, in some repurchase agreements, a customer or consignee may have physical possession of an asset that the entity controls. Conversely, in some bill and hold arrangements, the entity may have physical possession of an asset that the customer controls. Further guidance on such arrangement is set out. Letter D. The customer has the significant risks and rewards of ownership of the asset. The transfer of the significant risks and rewards of ownership of an asset to the customer may indicate that the customer has obtained the ability to direct the use of and obtain substantially all of the remaining benefits from the asset. However, when evaluating the risks and rewards of ownership of a promised asset, an entity excludes any risks that give rise to a separate performance obligation in addition to the performance obligation to transfer the asset. For example, an entity may have transferred control of an asset to a customer but not yet satisfied an additional performance obligation to provide maintenance services related to the transferred asset. Lastly, letter E, the customer has accepted the asset. The customer's acceptance of an asset may indicate that it has obtained the ability to direct use of and obtain substantially all of the remaining benefits from the asset. Further guidance on how to evaluate the effect of a contractual customer acceptance clause on when control of an asset transferred is considered. If a performance obligation is not satisfied at a point in time, it is satisfied over time. The other different way of satisfying a performance obligation is over time. So, in this case, the revenue is recognized over time too. So, it means that you would need to recognize a revenue gradually over the contract period and not as a single amount when the contract is completed. Revenue is recognized over time when any of the following is satisfied. Letter A. The customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. For example, are the routine or recurring payroll processing services. Letter B. The entity's performance creates or enhances an asset that the customer controls as asset is created or enhanced. For example, constructing an asset on a customer site. Letter C. The entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to receive payment for the performance completed to date. For example, constructing a specialized asset that only the customer can use, or constructing an asset in accordance with the customer order. A key part of the model is the concept that for some performance obligations, control is transferred over time, while for others, control transfers at a point in time. Guidance is given in the standard to help entities decide which is appropriate. Effective date and transition. IFRS 15 is effective for annual reporting periods beginning on or after January 1, 2018. IFRS 15 is required to be applied for annual reporting periods beginning on or after January 1, 2018, with earlier application permitted. If an entity chooses to apply IFRS 15 for an annual period beginning before January 1, 2018, it is required to disclose that fact. An entity that chooses to restate only the current period is required to provide the following additional disclosures in the initial year of adoption. the current year impact of applying the new revenue standard by financial statement line item, and an explanation of the reasons behind the significant impacts. Here are the differences between the IFRS 15 and the old revenue recognition standards. Contract costs, one framework with many judgment and estimations, and detailed disclosure. On the contract costs, when considering how to account for costs that are incurred before a contract exists or the pre-contract costs, it is important to keep in mind that they may include both cost of obtaining a contract and cost in fulfilling a contract, and that the requirements in respect of each are different. In particular, IFRS 15 makes clear that in some circumstances, it may be appropriate to recognize an asset for costs incurred to fulfill a contract that does not yet exist. IFRS 15 introduces guidance on how to account for costs associated with a contract with a customer when they do not fall within the scope of another standard. It distinguishes between cost of obtaining a contract and cost of fulfilling a contract. Cost to obtain a contract. In the previous IFRS, they do not include specific guidance on the accounting for the cost to obtain a contract with the customer. In fact, it is only limited circumstances that direct and incremental recoverable costs to obtain an identifiable contract may qualify as recognition as an intangible asset, or the IAS 38. For contracts within the scope of IAS 11, costs related directly to the contract with the customer and incurred in securing it were included as part of the contract cost only if the following criteria are met. First, if they can separately identified, reliably measured, and it is probable that the contract will be obtained. Under IFRS 15, incremental costs of obtaining a contract are those costs incurred in obtaining a contract that would not have been incurred that individual had not been obtained. This is restrictive, as any ongoing cost of operating the business will expense as incurred. On the other hand, on the cost to fulfill a contract, the new guidance on cost to fulfill a contract will be relevant for contracts that were being accounted for using the percentage of completion method. IFRS 15 requires an entity to capitalize the cost of fulfilling an anticipated contract if certain conditions are met. This is similar to the notion in IAS 11 that costs incurred before a contract is obtained are recognized as contract costs if it is probable that the contract will be obtained. One framework with many judgment and estimations. The use of varying standards meant that inconsistencies arose between financial statements issued which affect the goal of having a comparable financial statements. All previous standards are now being replaced by one framework, but with many possible judgment and estimations. IFRS 15 is an objective-based standard, meaning that reporting entities have the flexibility to choose various methods based on the standard's principle and objectives. The reporting entity shall determine which methods provide the most relevant and useful information for its business and the external users of their financial statements. For the disclosure, the level of detail necessary to satisfy the disclosure objective and how much emphasis to place on each of the various requirements will need to be considered. Disclosure should be included of both qualitative and quantitative information about all of the following. First, its contracts with the customer. Second, the significant judgment and changes in the judgment made in applying IFRS 15 to those contracts. And last, any assets recognized from the cost to obtain or fulfill a contract with a customer in accordance with the IFRS 1591 or IFRS 1595. IFRS 15 specifies that the level of information required to meet the disclosure objective, as well as the emphasis to be placed on each disclosure requirement, must be taken into account. The goal is to make sure that the information that users will find valuable isn't confusing by a lot of significant detail. Thus, things with sufficiently different properties are separated and presented individually. The objective of the disclosure requirement in IFRS 15 is that sufficient information is disclosed to enable users of financial statement to understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers.
Hello everyone. Today we will discuss the latest amendments of IFRS 17 insurance contracts. Prior to the completion of IFRS 17, yung insurance contract is under muna siya sa IFRS 4, kung saan ini-issue ito to make limited improvements to the accounting and disclosure of insurance contracts. Basically, under PFRS 4, ina-allow yung mga insurance companies to retain their accounting policies under their previous GAAP. At kung mapapansin natin, from IFRS 1 hanggang IFRS 17, ang wala lang yung IFRS 4. Kasi nga, tinanggal siya at mas inelaborate sa IFRS 17. Again, IFRS 17 replaces IFRS 4 insurance contracts. IFRS 17 insurance contracts establishes the principles for the recognition, measurement, presentation, and disclosure of insurance contracts within the scope of the standard. And yung isa nga sa objective ng IFRS 17 is that it ensures that yung mga entity nagpo-provide sila ng relevant information that faithfully represents those contracts. And yung mga information na to, ito yung nagbibigay ng basis sa mga users ng financial statements para ma-assess nila yung epekto ng insurance contracts sa financial position, financial performance, and cash flows dun sa entity. An entity shall apply IFRS 17 insurance contracts to the following. First, ina-apply siya sa mga insurance and the insurance contracts na in-issue ng insurer. Second, ina-apply siya sa reinsurance contracts held by an insurer. And third, ina-apply din yung IFRS 17 sa investment contracts with discretionary participation features na in-issue rin ng insurer. Provided na aside from the investment contracts, nag-i-issue din na insurance contracts yung entity. So here are some of the key terms under IFRS 17 insurance contract. Siyempre, unahin na natin, ano nga ba yung insurance contract? Insurance contract is a contract kung saan yung isang party or yung tinatawag ngayon natin insurer, ina-accept niya yung insurance risk from another party or yung insurance risk ng policyholder. So, paano paraan? Dito, yung insurer, pumapayag siya na i-compensate yung policyholder once na yung specified future event or the insured event adversely na naapektuhan yung policyholder. So the key terms in the definition of the insurance contract are the insurer, policyholder, and insured event. Pag sinabi natin insurer, it is the party na may obligation under the insurance contract na i-compensate yung policyholder once nga na magkaroon ng insured event. Example nito is yung insurance companies. Contrary sa definition ng isang insurer, policyholder is a party that has a right to compensation under an insurance contract if an insured event occurs. Lastly, when we say insured events, it is a certain future event that is covered by an insurance contract and creates insurance risk. Here are some of the examples of insurance contracts under PFRS 17. First, yung mga insurance against theft of damages. Next, yung mga insurance against product liability, professional liability, or legal expenses. Life insurance and prepaid funeral plans, life contingent annuities and pension, disability and medical cover, title insurance, or ito yung insurance against the discovery of defects in the title to land or buildings that were not apparent when the insurance contracts was issued. Next is yung travel insurance, or ito yung mga compensation na binibigay sa policyholders once na nagsuffer siya ng losses while traveling. Insurance contracts may be classified as direct insurance contract and reinsurance contract. Direct insurance contract is an insurance contract where the insurer directly accepts risk from the insured and assumes the sole obligation to compensate the insured in case of a loss event. Example, Mr. Juan obtains fire insurance for his house from ABC Insurance Corporation. In case of a fire, ABC Insurance Corporation is liable for compensating Mr. Juan for the losses incurred. This is an example of a direct insurance contract or simply insurance contract. ABC Insurance Corporation is the issuer, while Mr. Juan is the policyholder. The insurance contract, on the other hand, is an insurance contract issued by one insurer or the reinsurer to compensate another insurer, or what we also referred as the cedant, for losses on one or more contracts issued by the cedant. When we say reinsurer, it is the party that has an obligation under a reinsurance contract to compensate a cedant if an insured event occurs. Cedant, on the other hand, is the term used to the policyholder under insurance contract. Example, ABC Insurance Corporation is concerned about possible losses on insurance contract with Mr. Juan. Thus, ABC Insurance Corporation obtains insurance from XYZ Insurance Corporation for protection and against possible losses on insurance contracts against Mr. Juan. In case of fire, ABC Insurance Corporation compensates Mr. Juan. But this time, ABC Insurance Corporation can claim compensation from XYZ Insurance Corporation. Example to na isang insurance contract or tinatawag din siya na insurance of an insurance. ABC Insurance Corporation, yung tinatawag nating cedent or ceding company or primary insurer. XYZ Insurance Corporation naman yung reinsurer. Pag nag-enter sa isang reinsurance contract, may mamanage ng ABC Insurance Corporation yung risk of loss from the direct contract with Mr. Juan. Here are the other key terms under IFRS 17 insurance contracts. First, portfolio of insurance contracts. These are the insurance contracts that are subject to similar risks and are managed together. And when we say contractual service margin, it is a component of the carrying amount of the asset or liability for a group of insurance contracts representing the unearned profit the entity will recognize as it provides services under the insurance contracts in the group. Next, insurance risks. These are the risks other than financial risks. It is transferred from the holders of a contract to the insurer. And when you say financial risk, it is the risk of a possible future change in one or more of a specified interest rate, financial instrument price, commodity price, foreign exchange rate, index of prices or rates, credit rating or credit index or other variable, provided in the case of a non-financial variable that the variable is not specific to party to the contract. And when you say fulfillment cash flows, it is an explicit, unbiased, and probability-weighted estimate of the present value of the future cash outflows less the present value of the future cash inflows that will arise as the entity fulfills insurance contracts, including a risk adjustment for non-financial risk. Lastly, meron tayong tinatawag na risk adjustment for non-financial risk. And as the entity fulfills insurance contracts, meron siyang nire-require na compensation for bearing the uncertainty about the amount and timing of the cash flows na nag-arise from non-financial risk. Some contracts meet the definition of an insurance contract, pero ang primary purpose is the provision of the services for a fixed fee. Such issued contracts are still in the scope of the IFRS 17, unless an entity chooses to apply to them the IFRS 15 revenue from contracts with customers, and provided the following conditions are met. First, the entity does not reflect an assessment of the risk associated with an individual customer in setting the price of the contract with that customer. Next, rather than by making cash payments to the customer, the contract compensates the customer by providing services. And lastly, rather than from uncertainty over the cost of those services, the insurance risk transferred by the contract arises primarily from the consumer's use of services. There are three essential elements in the definition of the insurance contract. First, transfer of significant insurance risk. Dito, ipapasa ng policyholder or ng insured sa insurer or insurance provider yung significant insurance risk. Next, payment from the insured or premium. Here, generally, the insured pays to a common fund from which losses are paid, or meron siyang binabayaran na premium. Next, indemnification against loss. Dito, pumapayag yung insurer to identify the insured or other beneficiaries in case na magkaroon ng loss or liability from specified events and circumstances that may occur or be discovered during a specified period. An insurance contract may contain one or more components that would be within the scope of another standard if they were separate contracts. For example, an insurance contract may include an investment component or a service component or pwede rin both. In this case, nag-provide ng criteria yung standard para ma-determine kung yung non-insurance component is nakahiwalay ba talaga siya sa insurance contract. And based on the criteria, an entity shall apply IFRS 9 financial instruments to determine whether there is an embedded derivative to be separated, and if there is, how to account for such a derivative. First, separate from a host insurance contract an investment component. If and only if that investment component is distinct, the entity shall apply IFRS 9 to account for the separated investment component. And after performing the above steps, separate any promises to transfer distinct non-insurance goods or services. At yung mga promises na yun, i-account siya under IFRS 15, revenue from contracts with customers. Level of aggregation. IFRS 17 requires entities to identify portfolios of insurance contracts, which comprises contracts that are subject to similar risks and managed together. Contracts within the product line expected na magkapareho ng risk and expected then that if they are managed together, they are in the same portfolio. Each portfolio of insurance contracts issues shall be divided into a minimum of a group of contracts that are onerous at initial recognition, if any, a group of contracts that, at initial recognition, have no significant possibility of becoming onerous subsequently, and a group of the remaining contracts in the portfolio, if any. Remember that an entity is not permitted to include contracts issued more than 1 year apart in the same group. If contracts within the portfolio would fall into different groups only because law or regulation specifically constrains the entity's practical ability to set a different price or level of benefits for policyholders with different characteristics, the entity may include those contracts in the same group. For the recognition, an entity shall recognize a group of insurance contracts it issues from the earliest of the following. First, the beginning of the coverage period of the group of contracts, the date when the first payment from a policyholder in the group becomes due, and for a group of onerous contracts when the group becomes onerous. For the measurement, on initial recognition, an entity shall measure a group of insurance contracts at a total of the fulfillment cash flows, which comprise, first, estimates of future cash flows, next, and adjustments to reflect the time value of money and the financial risk associated with the future cash flows. And third, a risk adjustment for non-financial risk. And also, it includes the contractual service margin. An entity shall include all the future cash flows within the boundary of each contract in the group. The entity may estimate the future cash flows at a higher level of aggregation and then allocate the resulting fulfillment cash flows to individual groups of contracts. The estimates of future cash flows shall be current, explicit, unbiased, and reflect all the information available to the entity without undue cost and effort about the amount, timing, and the certainty of those future cash flows. They should reflect the perspective of the entity, provided that the estimates of any relevant market variables are consistent with the observable market prices. The discount rates applied to the estimate of cash flow shall first reflect the time value of money, the characteristics of the cash flows, and the liability characteristics of the insurance contracts. Next, it should be consistent with observable current market prices, if any, of those financial instruments whose cash flows characteristics are consistent with those of the insurance contracts. And it should include the effect of factors that influence such observable market prices but do not affect the future cash flows of the insurance contracts. On subsequent measurement, the carrying amount of a group of insurance contracts at the end of each reporting period shall be the sum of, first, the liability for remaining coverage comprising the fulfillment cash flows related to future services, and the contractual service margin of the group at that date, and also the liability for incurred claims comprising the fulfillment cash flows related to past service allocated to the group at that date. Under onerous contracts, an insurance contract is considered onerous at initial recognition if the total of the fulfillment cash flows, any previously recognized acquisition cash flows, and any cash flows arising from the contract at that date is a net outflow. An entity shall recognize a loss in profit or loss for the net outflow, resulting in the carrying amount of the liability for the group being equal to the fulfillment cash flows, and the contractual service margin of the group being zero. On subsequent measurement, if a group of insurance contracts become onerous or more onerous, that excess shall be recognized in profit or loss. Additionally, the contractual service margin cannot increase and no revenue can be recognized until the onerous amount previously recognized has been reversed in profit or loss as part of a service expense. Premium allocation approach. An entity may simplify the measurement of the liability for remaining coverage of a group of insurance contracts using the premium allocation approach. In other words, premium allocation approach is a simplified measurement of a group of insurance contracts. However, it is allowed only if at the group's inception, the entity reasonably expects that this would be a reasonable approximation of the general model, where the coverage period of each contract in the group is 1 year or less. Where, at the inception of the group, an entity expects significant variances in the future cash flows during the period before a claim is incurred. Such contracts are not eligible to apply the premium allocation approach. Using the premium allocation approach, the liability for remaining coverage shall be initially recognized as the premiums, if any, received at initial recognition minus any insurance acquisition cash flows. Subsequently, the carrying amount of the liability is the carrying amount at the start of the remaining period plus the premiums received in the period, minus the insurance acquisition cash flows, plus amortization of acquisition cash flows, minus the amount recognized as insurance revenue for coverage provided in the period, and minus any investment component paid or transferred to the liability for incurred claims.
Premium Allocation Approach or PAA is mentioned by Ms. MANIQUIZ. So, ito nga yung simplification ng measurement ng liability for remaining coverage for insurance contracts with short-term coverage. So, before we talk about practical expedients available under the Premium Allocation Approach, ano nga ba yung practical expedient? Ito yung isang accounting policy election na inaalaw ng Financial Accounting Standards Board or FASB. Para saan to? It provides relief from the burden on financial statement preparers to apply the requirements of an accounting standard or sometimes simplify the ongoing compliance. Now, let's dive into practical expedients available under the Premium Allocation Approach. Kapag may significant financing component yung insurance contracts in the group, yung liability for remaining coverage ay need to be discounted, pero hindi siya required if at initial recognition, the entity expects that the time between providing each part of the coverage and yung due date of the related premium is no more than a year. In applying PAA, an entity may decide to recognize any insurance acquisition cash flows as an expense when it incurs those costs. Basta provided na yung coverage period at initial recognition ay no more than a year. Yung simplifications na nag-arise sa premium allocation approach ay hindi na-apply sa measurement ng group's liability for incurred claims measured under the general model. However, there is no need to discount those cash flows if yung balance is expected to be paid or received in 1 year or less from the date the claims are incurred. Investment contracts with ATPF. Ito yung contracts kung saan yung investor ay nakakatanggap ng additional payment, the amount or timing of which is contractually at the discretion of the issuer. Ang investment contract with a discretionary participation features ay isang financial instrument and it does not include the transfer of significant insurance risk. It is in the scope of the standard only if the issuer or yung entity also issues insurance contracts. The requirements of the standards are modified for such investment contracts. Reinsurance contracts held. A separate measurement model applies to the reinsurance contracts held. Modifications are allowed para sa qualifying short-term contracts and participating contracts. The requirements of the standard are modified for reinsurance contracts held. Kapag ini-estimate yung present value ng future expected cash flows for insurance contracts, entities use assumptions consistent with those used for related direct insurance contracts. Additionally, the risk of reinsurer's non-performance is included in the estimate. The risk adjustment for non-financial risk is estimated to represent the transfer of risk from the holder of the reinsurance contract to the reinsurer. On initial recognition, the contractual service margin is determined similarly to that of insurance contracts issued. Maliban sa yung contractual service margin represents net gain or loss on purchasing reinsurance. Sa initial recognition, yung net gain or loss na ito ay dinidefer unless yung net loss relates to events that occurred before purchasing a reinsurance contract, in which case it is expensed immediately. Subsequently, reinsurance contracts held are accounted similarly to insurance contracts under the general model. Changes in reinsurer's risk of non-performance are reflected in profit or loss and do not adjust the contractual service margin. Modification and the recognition. Modification of an insurance contract. If the terms of an insurance contract are modified, dapat i-recognize ng entity yung original contract and recognize the modified contract as a new contract if there is a substantive modification based on meeting any of the specified criteria. The modification is substantive if any of the following conditions are satisfied. If, had the modified terms been included at contract's inception, this would have led to exclusion from the standard scope, unbundling of different embedded derivatives, redefinition of the contract boundary, or the reallocation to a different group of contracts, or if the original contract met the definition of direct or insurance contracts, but the modified contract no longer meets that definition, or vice versa. Or the entity originally applied the premium allocation approach, but the contract's modification made it no longer eligible for it. The recognition. Dapat magde-recognize ang entity ng insurance contract when it is extinguished, or if any of the conditions of a substantive modification of an insurance contract are met. Presentation. Presentation in the statement of financial position. Yung statement of financial position should present in separate captions yung asset and liabilities arising under insurance contracts issued and reinsurance contracts held. An entity shall present separately in the statement of financial position the carrying amount of group stock, insurance contracts issued that are asset, insurance contracts issued that are liabilities, reinsurance contracts held that are assets, and reinsurance contracts held that are liabilities. In contrast sa practices existing under various local GAAPs, entities should adopt a grossed-up presentation where contracts which are assets are not netted off against contracts which are liabilities and vice versa. Hindi minamandate ng IFRS 17 yung layout ng Statement of Financial Position. The reporting entity should follow the general requirements of IAS 1 but need to ensure that certain captions are presented as a minimum on the face of the statement. Recognition and presentation in the Statement of Financial Performance. Hindi minamandate ng IFRS 17 yung layout ng Statement of Financial Performance. Reporting entities should follow the principles and requirements of IAS 1 and the measurement rules of IFRS 17, which require that revenue and incurred expenses presented in profit or loss exclude any investment components. An entity shall disaggregate the amounts recognized in the Statement of Financial Performance into an insurance service result comprising insurance revenue and insurance service expenses, and insurance finance income or expenses. Income or expenses mula sa insurance contracts held shall be presented separately from the expenses or income from insurance contracts issued. Insurance service result. An entity shall present in profit or loss yung revenue na nag-arise sa groups of insurance contracts issued, and insurance service expenses na nag-arise sa group of insurance contracts it issues, comprising incurred claims and other incurred insurance service expenses. Revenue and insurance service expenses shall exclude any investment components. An entity shall not present premiums in the profit or loss if that information is inconsistent with revenue presented. Insurance finance income or expenses. Insurance finance income or expenses comprises the change in the carrying amount of the group of insurance contracts arising from the effect of the time value of money and the changes in the time value of money, and the effect of changes in assumptions that relate to financial risk, but excluding any such changes for groups of insurance contracts with direct participating insurance contracts that would instead adjust the CSM. May accounting policy choice ang mga entity in choosing between including all of insurance finance income or expense for the period in profit or loss or disaggregating it between an amount presented in profit or loss and an amount presented in other comprehensive income or yung OCI. Disaggregate. Under the general model, disaggregating means presenting in profit or loss an amount determined by a systematic allocation of the expected total insurance finance income or expenses over the duration of the group of contracts. On one hand, under the variable fee approach, for direct or insurance contracts, only where the entity holds the underlying items, disaggregating means it represents just a profit or loss as insurance finance income or expenses, an amount that eliminates the accounting mismatches with the finance income or expenses arising on the underlying items. The recognized, under the general model on the recognition of the groups, amounts remaining in OCI are reclassified to profit or loss, while under naman sa variable fee approach on the recognition of the groups, the amounts previously recognized in OCI remain there. Disclosures. Ang objective ng disclosure requirements ng IFRS 17 ay ang i-disclose ang mga information which allows yung users ng financial statements to assess the effect that contracts within the scope of the standards have on the entity's financial position, financial performance, and cash flows. An entity should provide qualitative and quantitative information about the amounts recognized in its financial statements that arise from insurance contracts, the significant judgments, and changes in those judgments made when applying IFRS 17, and the nature and extent of the risk that arising from insurance contracts within the scope of the standard. Required ang entities na sundin ang requirements ng IAS 1 regarding sa materiality and aggregation when deciding what aggregation bases are appropriate for disclosure. Effective date. IFRS 17 has a revised effective date of January 1, 2023 but may be applied earlier provided na yung entity applies IFRS 9 and IFRS 15 at or before the date of initial application of the standard and subject to any considerations imposed by local legislation. The effective date was revised in June 2020 as part ng series of amendments to IFRS 17 which would be discussed by Ms. Africa. Transition. An entity shall apply the standard retrospectively unless impracticable, in which case entities have the option of using either the modified retrospective approach or yung fair value approach. Under sa modified retrospective approach, an entity shall utilize reasonable and supportable information and maximize the use of information that would have been used to apply a full retrospective approach, but need only use information available without undue cost or effort. Under this approach, the use of hindsight is permitted if that is the only practical source of information for the restatement of prior periods. Under sa fair value approach, an entity determines the contractual service margin at the transition date as the difference between ng fair value of a group of insurance contracts at that date at ng fulfillment cash flows measured at that date. Using this approach, on transition, there is no need for annual groups. At the date of initial application of the standard, those entities already applying IFRS 9 may retrospectively redesignate and reclassify financial assets held in respect of activities connected with contracts within the scope of the standard. Pwedeng mamili yung entities na huwag nang i-restate yung IFRS 9 comparatives with any difference between sa previous carrying amount ng financial assets at sa carrying amount at the date of initial application, recognized in the opening equity at the date of initial application. Any restatement of prior periods must reflect all the requirements of IFRS 9.
So yung next part naman po ng report namin is about the amendments. Since bago pa lang po si IFRS 17, dalawa pa lang po yung amendments sa kanya. Yung una po is yung major amendment po sa IFRS 17 and yung pangalawa naman po is yung amendment regarding po sa initial application ng IFRS 17 and IFRS 9. So yung una pong amendment sa IFRS 17 was dated June 25, 2020. Yung development po is amended by amendments to IFRS 17. Comments po about this amendment naman is that the amendments which include po yung deferral ng effective date ng standard are effective po for the annual periods beginning on or after January 1, 2023 na i-discuss ko po later. Next naman po, IASB finalizes narrow scope amendments to IFRS 17 and IFRS 4. So yung International Accounting Standards Board or si IASB po, nag-issue sila ng amendments to IFRS 17 and the reason behind this po is para i-address yung mga concerns and implementation challenges po na nakita nila after po nila i-publish yung IFRS 17 insurance contracts noong 2017. So, effective po yung amendments for the annual periods beginning on or after January 1, 2023 with earlier application permitted. Nag-publish din po si IASB ng extension of the temporary exemption from applying IFRS 9 amendments to IFRS 4 para i-defer din po yung fixed expiry date ng amendments to the annual period beginning on or after January 1, 2023. So before we discuss po yung mga changes galing po sa amendments, let's take a look first po sa short background po ng amendment. So since May 2017, the date po kung kailan in-issue si IFRS 17 insurance contracts, yung board or si IASB ay continuous po yung pag-monitor nila sa implementation, and that is why the board is aware of the concerns and implementation challenges regarding po sa IFRS 17. So before pa po i-release itong amendments, nagpapahiwatig na po yung board that they are open and willing to consider additional action if kailangan po para i-address yung mga concerns na nakikita during the implementation po ng standard. So no October 2018, nagkaroon po sila ng board meeting and they were able to list down 25 potential amendments, and napag-usapan din po nila doon yung mga criteria against kung ano po yung amendment na i-consider nila. Nung June 26, 2019 naman po, exposure draft of proposed amendments with comments request by September 25, 2019 was published. So nagkaroon po ng mga deliberations sa project po regarding the possibility ng amendments to IFRS 17 following nung end po nung comment period. So si IASB po, nirefine po nila yung proposal nila and they acquired additional feedback galing po sa mga constituents po ng board, and with that po resulted sa final amendments na in-issue po nung June 25, 2020. So next naman po, let us discuss na po yung mga changes na galing po sa amendments to IFRS 17 and extension of the temporary exemption from applying IFRS 9 amendments to IFRS 4. So una po is the effective date of IFRS 17 and the IFRS 9 temporary exemption. So effective date of IFRS 9 before effective date of January 1, 2021 with early application permitted, and after effective date deferred by 2 years to January 1, 2023 with early application permitted. IFRS 9 temporary exemption before annual reporting periods beginning on or after January 1, 2021 and after annual reporting periods beginning on or after January 1, 2023. So yung unang amendment po is yung deferral po ng date kung kailan po dapat i-apply ng mga entities yung IFRS 17. So nagdagdag po sila ng 2 years from annual reporting periods beginning on or after 2021 to annual reporting periods beginning on or after 2023, and makikita nyo po yung graph representation sa screen nyo. Dahil po sa deferral po na ito, nabigyan po ng additional time para po ma-adapt and ma-implement po itong amended standard IFRS 17. Yung mga nag-a-apply daw po ng IFRS 9 financial instrument, they can still apply the standard earlier than the effective date, and required din daw po na magkaroon ng 1 period of adjusted comparative IFRS 17 implementations. Nung deliver po nila yung effective date, na-adjust din po yung temporary exemption na pag-a-apply po ng IFRS 9 sa ibang eligible insurer from January 2021 to January 2023. Ibig sabihin po nito, yung mga insurer po na ito ay pwede po nilang i-apply yung IFRS 9 and IFRS 17 na magkasabay without the need to early adopt po yung IFRS 17. So next naman po is about the scope of IFRS 17, credit cards and similar contracts. Before applies to all insurance contracts with some specific exclusions. After, one new scope exclusion added to IFRS 17. Yung next amendment naman po is about po sa scope po ng IFRS 17. Yung IFRS 17 po kasi ina-apply po siya sa lahat ng insurance contracts with some specific scope exclusions na makikita nyo po sa screen nyo. So ngayon, sa amendment po na to, nagdagdag po sila ng isa pa pong scope exclusion about some credit cards and similar contracts, yung color red po sa screen nyo. Dinagdag po nila ito kasi meron daw pong mga contracts na nagpo-provide ng credit or payment arrangement, tapos nami-meet po na yung definition ng insurance contracts. Kasi inside that contract is may insurance po. So for example po sa bank, di ba yung mga account po natin like time deposit, savings, usually meron po silang insurance until 500,000 pesos. So ganun po. And dahil po sa amendment po na ito, excluded na po yung ganung contract sa scope po ni IFRS 17 kung hindi po nare-reflect sa assessment of the insurance risk associated sa individual customer sa entity sa pag-set po ng price ng contract with that specific customer. Sa tingin daw po kasi ng board, mas useful po yung IFRS 9 sa ganung contracts. Pero they also concluded that the IFRS 17 will give more useful information about po dun sa insurance coverage component embedded sa contract nila. So kapag yung insurance component daw po ay part ng contractual terms ng entity, kailangan po niya i-separate yung component po na ito and i-apply po niya yung IFRS 17 sa pag-a-account po nito. So next naman po is another scope of IFRS 17, some loan contracts. So before, choice to apply IFRS 17 or another IFRS standard for some contracts. After, one new choice added to IFRS 17 scope requirements. Another amendment po about the scope in IFRS 17 is about some loan contracts. Nagbibigay po kasi ng option sa IFRS 17 kung paano po i-account yung ibang insurance contracts. Kung IFRS 17 po ba yung gagamitin nila or ibang standard. So, yung amendment po dito is nagdagdag po sila ng isa pang type ng contract kung saan pwede pong mamili si entity kung anong standard yung kanyang gagamitin. IFRS 17 ba or IFRS 9. Ito nga po yung mga loan contracts na namimit din po yung definition ng insurance contract pero limit po sa compensation sa ibang mga insured events sa amount na required para isettle yung obligation ni policyholder. So for example po, yung loan contracts with debt waivers or lifetime mortgages. Sa tulad din po kanina, na-realize po ng board na pwede pong magkapag-provide ng mas useful information about po sa ganitong contract sa IFRS 9 or sa IFRS 17. Another notable difference po nitong nadagdag na contract kumpara po sa dalawang nauna, if titingnan nyo po sa screen nyo, is yung condition po. Magkakaroon lang daw po ng choice si entity para po sa whole portfolio ng insurance contracts kesa po sa bawat contracts per individual. The reason behind this po is that it mitigate po yung lack of comparability. Kasi mamaya po same contract lang naman po sila pero iba-iba po yung ina-apply po ni entity na standard. So next naman po is about the reinsurance contracts held. So before, the net cost or the net gain of reinsurance contracts held recognized over time. After, loss recoveries on reinsurance contracts held recognized at same time as day one losses on onerous underlying insurance contracts issued and adjusted net cost or net gain recognized over time. Yung next amendment naman po is about sa reinsurance contracts held. Yung 2017 version daw po kasi nung standard is hindi po niya kino-cover yung situation about sa mga underlying contracts na onerous, bothersome o mabigat at initial recognition. Yung IFRS 17 po kasi nire-require niya si entity na i-recognize yung any losses on initial recognition ng insurance contracts issued immediately sa profit or loss. Before the amendments po, yung mga net loss or net gain na sa pag-purchase po ng reinsurance contracts held ay nire-recognize over time with no amount being recognized immediately. And dahil po dito, nagkakaroon po ng accounting mismatch. Dahil yung loss po sa insurance contract ay nare-recognize agad-agad, tas yung mga recovery po sa mga loss sa reinsurance contracts held ay nire-recognize naman po over time. And in-address po ng amendment na to yung mismatch by requiring po yung mga entity na i-recognize yung mga loss recoveries at the same time ng pag-recognize nila ng losses sa initial recognition ng underlying insurance contracts. So may example po dyan sa screen nyo. Pinapakita po niyan na si entity po ay nag-issue po ng isang onerous insurance contract and nag-expect po sila na magkakaroon po sila ng loss na 50 and i-recognize po nila ito immediately sa profit or loss on day 1. May kita din po dyan, on the same time, nag-enter po sila sa isang reinsurance contracts kung saan pwede po siyang makarecover ng 80% ng lahat ng claims sa onerous underlying insurance contracts. So before po, nung amendment, si entity nag-recognize po siya ng net loss ng 5 over time with no amount na ni-recognize ng day 1. So applying po yung amendment, dapat po i-recognize yung loss recovery na 40 on day 1, nakuha po siya by multiplying yung 50 with the percentage ng claims na ina-expect na ma-recover ni entity which is 80%. Sabi po ng amendment, yung loss po sa insurance contract na 50 will be treated as early recognition ng portion ng claims and yung loss recovery naman po na 40 sa reinsurance contract held will be treated as early recognition ng portion of claim recoveries. Yung loss and loss recoveries daw po ay dapat magkaiba yung kanilang line item sa profit or loss and kailangan po silang i-disclose separately sa notes. Additional information po about sa amendment po na to, bago daw po ito ma-apply, dapat yung reinsurance contract held ay mangyari before or at the same time nung i-recognize yung loss sa underlying insurance contracts. I-apply din daw po itong amendment na ito regardless kung yung insurance contract held na kino-covered po niya is fixed proportion of claim or nagpo-provide ng ibang type ng coverage like excess of loss. Tapos naka-specify din daw po sa requirement kung paano kino-compute yung amount of loss recovery na dapat i-recognize. The next naman po is about the insurance acquisition cash flows. So before, the insurance acquisition cash flows paid, example, commission paid, are recognized as an asset until the initial insurance contracts they relate to are recognized. And after, a portion of such an asset continues to be recognized until expected renewals of those initial insurance contracts are recognized in the future. So yung next amendment naman po is about sa insurance acquisition cash flows. Nire-require daw po ng IFRS 17 na i-consider ni entity yung insurance acquisition cash flows kapag inaalam po nila yung contractual service margin ng insurance contracts. Generally daw po, yung insurance acquisition cash flows na binayaran after i-recognize yung group of insurance contracts. Nakukuha po yung result dito kapag ini-include po sila sa cash flow expected na mag-fulfill sa contracts. Yung mga insurance acquisition cash flows naman po na binayaran after i-recognize yung group of insurance contracts, nakukuha naman daw po yung result dito kapag nire-recognize sila as asset until i-recognize yung related group. So para po mas maintindihan yung amendment po na to, tignan po natin yung example. Kasi hindi daw po na-cover yung ganitong scenario, kaya po nagkaroon ng amendment regarding dito. Diyan po, makikita natin na si entity po, nagbayad po siya ng commission na 150 para po sa mga bagong contracts na maipebenta later in the year. And ito po yung tinatawag na initial contract. So yung commission po na ito ay na-meet po niya yung definition ng insurance acquisition cash flows and directly attributable po ito sa mga initial contracts. Yung premium po na ina-expect ni entity na ma-receive galing sa initial contract ay 100 na mas mababa po sa commission na 150 na binayad nila. Okay lang daw po kay entity kahit mas mataas yung bayaran nila kaysa sa matanggap nila kasi ina-expect po nila na yung ibang policy holders ay magre-renew naman daw po ng initial contracts in year 2 and 3. So before po nung amendments, IFRS 17, nire-require po niya si entity na i-allocate yung full amount ng commission only to the group that will include the initial contracts. As in po, sa example, yung full commission na 150, dun lang po siya naka-allocate sa year 1 sa initial contract and nag-result po siya ng loss na 50 sa year 1. And sabi po ng amendment, yung entity dapat daw po i-allocate po niya yung portion ng commission sa future groups expected to include renewals to the initial contracts. And dahil po dito, naging systematic and rational yung method ng pag-allocate. So makikita po sa example, after applying po ng amendment, si entity, inallocate po niya yung commission na 150 evenly sa initial contracts in year 1 and sa mga expected renewals sa year 2 and 3. And nag-result po ito ng profit na 50 sa year 1, 2, and 3. So yung consequence po rito, yung asset daw po sa insurance acquisition cash flow ay magkakaroon ng mas mahabang duration and mas malaking amount. Kaya nag-add po sila ng impairment test sa requirement po ng standard as well as some additional disclosure about sa asset po na to kasi maaari daw po kasi ma-impair yung asset. So next naman po is about profit recognition. So before, for general model contracts, profit is recognized over time as the entity provides insurance coverage. After, for general model contracts, profit is recognized over time as the entity provides insurance coverage and investment return service, if any. So next amendment naman po is about profit recognition. In-identify po ni IFRS 17 kung paano po dapat i-recognize yung profit sa isang contractual service margin kung saan si entity ay nagpo-provide po siya ng service sa kanyang policyholders. Before the amendment daw po, yung mga requirement po na nakalagay sa IFRS 17 regarding dito ay para lang po sa mga insurance contracts na nagpo-provide lang ng insurance coverage And yung amendment po na ito, kinover po niya yung situation kung saan yung insurance contract ay nagpo-provide ng both insurance coverage and an investment return service. Naapektuhan po ng amendment yung profit recognition pattern ng contract kung saan yung general model ay na-apply. Yung insurance contract without direct participation features kung yung entity po ay nagpo-provide ng investment return service as part po ng contract. Yung ganitong contracts po before the amendment po, nire-require ni IFRS 17 yung entity na i-recognize yung profit as the entity provides insurance coverage without consideration po sa mga investment return service as shown po sa diagram. After the amendment po, nire-require na po na i-recognize the entity yung profit as it provides both insurance coverage and investment return service. And in-specify din po ng standard kung kailan po yung insurance contract sa general model ay maaaring nagpo-provide ng investment return service. Yung isang contract daw po, masasabing maaari po siyang nagpo-provide ng investment return service kapag una, kapag may nag-exist daw po na investment component or yung policy holder ay merong right na mag-withdraw ng amount. Pangalawa po, yung entity daw po ay nag-expect sa investment component or sa amount po ng policy holder na may right po na mag-withdraw na mag-include po ng investment return, and lastly po, nag-expect po si entity na mag-perform ng investment activity para makapag-generate ng investment return. Mahalaga daw po yung mga condition na yan para po makonsider na investment return service ay nag-exist po, pero hindi naman daw po sila determinative. Pwede po kasing sabihin ni entity na wala pong investment return service na nangyayari kahit po na-meet po yung tatlong condition. Nagdagdag din po sila ng requirement regarding po sa disclosure dito. Kailangan daw po mag-provide ng quantitative information sa appropriate demands kung kailan po nila expect na i-recognize yung contractual service margin sa profit or loss, and kailangan din po nila i-disclose yung judgment nila regarding sa pag-determine po nila sa pag-weigh ng benefit provided ng insurance coverage and ng investment return service para sa contracts sa general model and insurance coverage and investment related service for the contract in the variable fee approach. Inamend din po dito yung requirements na nagsasabi po kung kailan yung investment activity cost ay dapat naka-include sa measurement ng fulfillment cash flows. Next naman po is about the effect of previous interim reports. Before, an entity is required not to change the treatment of estimates made in previous interim reports, in subsequent interim reports, and in the annual report. And after, an entity can choose whether or not to change the treatment of the estimates made in the previous interim reports. Yung next na amendment naman po is about sa mga entity na nagpre-prepare po ng interim reports na ang ina-apply po na standard is IS34 Interim Financial Reporting. Kapag ginagamit daw po yung IFRS 17, yung frequency po ng reporting ay pwede pong maka-apekto kung yung change in estimate is maa-adjust nga yung contractual service margin or i-recognize ito immediately sa profit or loss. Pwede din po nitong maapektuhan yung pattern ng pag-recognize ng contractual service margin. Before po ng amendment, nire-require po ng IFRS 17 na hindi po baguhin ni entity yung treatment po nila sa estimates made in the previous interim reports, in subsequent interim reports, and pati na din po sa annual report. After po ng amendment, pinapayagan na po ng IFRS 17 ang pagpili po ng accounting policy kung papalitan po nila yung treatment sa estimates made in previous interim report. Yung choice daw po na pipiliin ni entity, ito po dapat yung i-apply sa lahat ng insurance contracts issued and reinsurance contracts held nila. Para po mas maintindihan natin yung amendments, punta po tayo sa example. Makikita nyo po sa example na si entity nag-prepare po sila ng interim reports for each quarter and meron din po silang annual report. So sa umpisa daw po ng year 1, nag-issue daw po ng insurance contract na may 2-year coverage period sa entity. And based daw po sa expectation ng entity during the beginning of year 1, kailangan po nilang mag-recognize ng 6.25 ng contractual service margin na sa profit or loss for each quarter over the 8 quarters ng coverage period. So may total po itong contractual service margin na 50. Yung contractual service margin daw po kasi nire-recognize po siya over the coverage period na ina-apply po yung coverage unit requirements. So sa example po natin, yung contractual service margin at the end po ng third quarter will be 31.25. Nakuha po ito by multiplying 6.25 and 3 minus 50. Tapos sabi po dyan, sa example, sa final quarter daw po ng year 1, nagpalit po ng expectation sa entity para sa year 2. And dahil po dito, nagkaroon po ng decrease sa contractual service margin, naging 30 na lang daw po. Kapag si entity po, pinili nila na hindi po palitan yung changes in estimates sa ginawa po nila previously kapag nag-prepare po sila ng fourth quarter interim report and annual report, so mag-a-adjust po nito yung current amount ng contractual service margin sa end po ng third quarter from 31.25 to 30 na magre-result po ng remaining contractual service margin of 1.25 sa end po ng third quarter. So ano pong mangyayari dito? I-recognize po ito over the remaining 5 quarters ng coverage period, meaning magre-recognize po ng 0.25 per remaining quarter. So yun po yung nangyayari sa period-to-period basis na nire-require po dati ni IFRS 17. So ngayon po, tingnan naman po natin kung ano po yung mangyayari kapag in-apply na po yung amendment. And si entity po ay pinili po niya na baguhin yung kanilang estimates. So ito po yung year-to-date basis. Dito po yung fourth quarter, i-adjust po ni entity yung overall contractual service margin na 50 by 30. So meaning may matitira po ang contractual service margin na 20 before po mag-allocate sa year 1 and year 2. So makikita nyo po sa example natin na yung service po ay pinoprovide evenly over the 2 years. Therefore, si entity po ay dapat mag-recognize ng 10 na contractual service margin sa profit or loss sa year 1 and year 2. Next naman po is about balance sheet presentation. So before, groups of insurance contracts that are assets and those that are liabilities presented separately. After, portfolios of insurance contracts that are assets and those that are liabilities presented separately. Example, presented at a higher level. So yung next amendment naman po is about sa presentation ng insurance contract sa balance sheet. Nire-require po ng IFRS 17 na mag-recognize and measure ng groups of insurance contracts sa entity. Ito nga po yung level of aggregation requirements. So before po ng amendment, nire-require po ng IFRS 17 na mag-present po sa entity sa balance sheet ng groups of insurance contracts that are assets separately po dun sa mga liabilities. And ito po ay consistent naman po sa level kung saan po nagre-recognize and measure ng insurance contracts sa entity. So after po ng amendment, nire-require na po na mag-present po sa balance sheet si entity ng portfolio of insurance contracts that are assets separately dun sa mga liabilities. Yung portfolio po ng insurance contracts, it may consist po ng several groups of contracts including some groups that are assets and others that are liabilities. In general daw po, most groups of insurance contracts ay nasa liability position. Katulad po nung nasa example natin. Yung portfolio 1 po ay merong tatlong groups. Group A, asset, Group B, and C, liabilities. So in conclusion po, si portfolio 1 is an overall liability. So before ng amendment, ipepresent po ni entity yung Group A as an asset, tas Group B and C as a liability, as shown po sa example. After po ng amendment, sa liability lang po meron dahil yung portfolio po ay overall a liability. And portfolio na po yung nire-require ni IFRS 17 and hindi na po by group to simplify yung presentation ng insurance contracts. The next naman po is about the use of the risk mitigation option. So before, an entity can apply the risk mitigation option in the variable fee approach when it mitigates financial risk using derivatives. After, option extended to apply when an entity mitigates financial risk using derivatives, the insurance contracts held or non-derivative financial instrument at FVPL. So yung next amendment naman po is about sa risk mitigation option sa variable fee approach. Pinapayagan daw po ng risk mitigation option yung entity na mag-recognize ng changes in the effect of financial risk sa profit or loss kaysa mag-adjust po sila ng contractual service margin as normally required po sa variable fee approach. So before the amendment po, ina-apply lang po daw po yung risk mitigation option kapag gumagamit po ng derivative si entity para po ma-mitigate yung financial risk. Yung amendment po na to, in-extend po niya yung risk mitigation option para po pwede din po itong magamit kapag reinsurance contracts held or non-derivative financial instruments measured at fair value through profit or loss yung gamit ni entity sa pag-mitigate po ng kanilang financial risk. May dalawa pong component ng insurance contract kung saan pwedeng pumili si entity kung paano nila i-mitigate ang kanilang financial risk. Yung una nga po, yung fulfillment cash flow being mostly the cash flows that will be paid to the policyholders, and yung pangalawa naman po, yung share po ni entity sa fair value ng underlying items. Kapag reinsurance contracts held po yung ginagamit ni entity to mitigate their financial risk, ina-apply po yung risk mitigation option in the same way as it does po kapag derivatives ang gamit nila. So, ina-apply po ito kapag minimitigate po ni entity yung kanilang financial risk sa fulfillment cash flows and kung sa kanilang share po sa fair value ng mga underlying items. Para sa non-derivative financial instruments measured at fair value through profit or loss, yung application daw po ng risk mitigation option is more restricted. Kasi po, pwede lang po ito i-apply kapag si entity po ay nagmi-mitigate po ng kanilang financial risk sa fulfillment cash flow gamit po yung non-derivatives. Yung reason behind this po is that napagtanto po ng board na yung pag-extend po ng risk mitigation option sa pag-mitigate po ng financial risk ni entity sa kanilang own share of the fair value of underlying items gamit po yung non-derivatives financial instruments would undermine po yung principle na yung variable fee approach po ay ina-apply regardless of whether an entity hold the underlying items. Yung next amendment naman po is about sa ilang additional transition, modification, and relief sa pag-a-apply po ng IFRS 17. So una po, transitional modification and reliefs about the reinsurance contracts held. Full retrospective approach determine loss recoveries that would have been recognized at initial recognition of the onerous contracts and roll forward to determine loss recovery component to the transition date. Modified retrospective approach and fair value approach, relief added for determining loss recovery component at transition date. So yung una po is about po sa measurement of a loss recovery component on reinsurance contracts held at the transition date. Sa full retrospective approach po, yung entity, kailangan po niyang i-determine yung loss recovery component ng group of the insurance contracts held na dapat i-recognize at initial recognition ng onerous underlying insurance contracts and i-roll forward po yung loss recovery component to the transition date habang ina-apply po yung IFRS 17 requirements para sa subsequent measurement at each reporting date between sa recognition of the onerous insurance contracts and sa transition date. Applying naman po yung transition relief sa modified retrospective approach and fair value approach, sa entity po, i-determine niya yung loss recovery component at transition date in a more direct way na nakabase po sa information at that date. Para po makompute yung loss recovery component ng reinsurance contract held at transition date, imumultiply lang po yung loss component ng onerous underlying insurance contracts at transition date sa percentage of claims entity expects to recover from the reinsurance contracts held using po yung expectation at the transition date as shown po sa slide. Sa pag-a-apply po ng relief na ito, hindi na po required si entity na i-calculate pa po kung ano pa yung loss recovery component nung initial recognition ng onerous underlying insurance contracts or at any reporting date between initial recognition and nung transition date. And kapag walang reasonable and supportable information sa entity para i-apply yung relief sa modified retrospective approach, i-assume po ni entity na nil or zero po yung loss recovery component at the transition date. Next naman po sa transitional modification and reliefs is about sa insurance acquisition cash flows. The full retrospective approach determines asset that would have been recognized for insurance acquisition cash flows paid before the transition date and roll forward to transition date. Modified retrospective approach and fair value approach, relief added for determining asset at transition date. The next naman po sa relief under this amendment po is about po sa asset for insurance acquisition cash flows recognized at the transition date. Connected po ito sa nabanggit ko kanina about sa amendment sa insurance acquisition cash flows, yung consequence po na nabanggit ko doon ang dahilan kung bakit nagdagdag po ang board ng relief regarding dito. So sa pag-a-apply po ng full retrospective approach, dapat daw po i-recognize and i-measure ni entity yung assets for insurance acquisition cash flows as if IFRS 17 na daw po yung gamit nila ever since. And hindi daw po required na mag-assess si entity ng recoverability ng assets na to before the transition date. Applying naman po yung relief added sa modified retrospective approach, i-measure ni entity yung asset for insurance acquisition cash flows gamit yung mga reasonable and supportable information available ng transition date. As shown po sa slide, asset for insurance acquisition cash flows at transition date can be measured by subtracting po yung insurance acquisition cash flows paid or for which a liability has been recognized applying other IFRS standard before transition date, excluding po yung mga amount relating sa contracts na hindi nag-exist before transition date and the amount allocated to groups of contracts recognized at transition date, and kapag si entity po ay walang reasonable and supportable information para i-apply yung modification, the asset and the amount allocated sa groups of contracts recognized at transition date are determined as nil or zero. Applying naman po yung relief sa fair value approach, so yung amount ng asset for the insurance acquisition cash flows at transition date daw po dito ay na-determine equal sa amount na mai-incur ni entity at the transition date for specified rights to obtain recoveries of insurance acquisition cash flows and future insurance contracts. So next po about the transitional modifications and relief is about the effect of previous interim reports. So for the full retrospective approach, determine amounts at transition date retrospectively applying same accounting policy choice that the entity will use going forward for treatment of accounting estimates made in previous interim reports. And for the modified retrospective approach and fair value approach, relief added for entities that choose not to change treatment of accounting estimates made in previous interim reports. So yung next naman po na relief under this amendment is about the effect of previous interim reports. Sa pag-apply po ng full retrospective approach, dapat po kung ano ang choice ni entity sa treatment po ng accounting estimates made in previous interim reports, ay retrospective niya po itong i-apply. Like I discussed po earlier, may choice po si entity dito, and isa po sa choice is hindi po babaguhin yung treatment sa accounting estimates made in previous interim reports, pero may instance po kasi na baka wala po sila nung mga required, reasonable, and supportable information para mai-apply po nila ito retrospectively at transition. And dito po papasok yung relief. So applying na po yung relief, ide-determine po ni entity yung contractual service margin or yung loss component at the transition date as if hindi po nag-prepare si entity ng interim financial statements before the transition date as shown po sa example. Next naman po sa transitional modification and reliefs is about the investment contracts with discretionary participation features. So for the full retrospective approach, make specified assessment required by IFRS 17 using information that would have been available at initial recognition of the contracts. For the modified retrospective approach and fair value approach, relief for making specified assessments using transition date information extended to include assessment of whether a contract meets the definition of an investment contract with discretionary participation features. The next naman po na relief under this amendment is about the specified initial assessments na nire-required ni IFRS 17. Sa modified retrospective approach and fair value approach po, na unang in-issue ni IFRS 17, pinapayagan po dito na gamitin yung mga information na available at the transition date kesa po sa mga information ng initial recognition sa pag-perform po ng mga initial assessment na makikita nyo po sa slide. So una po yung pag-identify ng groups of insurance contracts, next po yung pag-identify ng discretionary cash flows for insurance contracts without direct participation features, and next po yung pag-assess sa contracts kung nami-meet po nito yung definition ng insurance contracts with direct participation features. Yung amendment po sa IFRS 17, in-extend po nila yung relief dito para maisama po yung further assessment about sa contract kung nami-meet ba nito yung definition ng investment contract with discretionary participation features. Next naman po sa transitional modification and reliefs is about the contracts required in their settlement period. So for the full retrospective approach, classify a liability for insurance contracts acquired in their settlement period before the transition date as a liability for remaining coverage. And for the modified retrospective approach and fair value approach, relief added to classify such a liability as a liability incurred claims. The next naman po sa relief under this amendment, apply sa insurance contracts acquired sa pag-transfer ng insurance contract or sa business combination within the scope of IFRS 3 na nangyari before ng transition date. Applying po yung full retrospective approach, nire-require po ng IFRS 17 sa entity na i-classify yung liability para sa insurance contracts acquired in their settlement period as a liability for the remaining coverage. Pero, may pagkakataon po na para sa ibang entity, may hirap po i-identify yung insurance contracts acquired in their settlement period bago po nung transition date separately from other contracts acquired when issued kasi pwede po yung system nila, hindi po ito nakaset up na gawin ito. And dito po papasok yung relief about sa modified retrospective approach and sa fair value approach. Dahil po dito, sa relief na ito, pinapayagan po na i-classify ng entity itong mga liability na ito as a liability for incurred claims instead po as a liability for remaining coverage as shown po sa slide. Next naman po about sa transitional modifications and reliefs is about the risk mitigation option date of application. So before, an entity is permitted to apply the risk mitigation option in the variable fee approach prospectively after the date of initial application. Retrospective application is prohibited. And after, an entity is permitted to apply option prospectively from an earlier date, transition date instead of the date of initial application. And yung last two amendments po under transitional modification and relief is about po sa risk mitigation option in the fee variable approach. So, pinagbabawal po ng IFRS 17 ang pag-a-apply ng risk mitigation option retrospective kasi may risk daw po dito ng paggamit ng hindsight. May mga concerns po about sa prohibition na ito and isa nga po dito ay magre-result daw po ito sa inconsistency regarding sa treatment po ng risk mitigation activities before and after po ng transition. And in response po sa concerns na to, gumawa po ng dalawang amendments yung board. Yung unang amendment po dito is yung pag-allow po ng IFRS 17 na i-apply po yung option prospectively from the earlier date from the transition date kaysa sa initial application date as shown po sa diagram. Sa pag-a-apply po ng amendment na to, an entity can reflect risk mitigation activities sa comparative period consistently with risk mitigation activities after the date of initial application ng IFRS 17. Next naman po sa transitional modification and relief still under risk mitigation option is the fair value approach. So before, an entity is required to apply a fully retrospective approach unless impracticable, but is prohibited from applying risk mitigation option retrospectively. After, exception added permitting an entity to apply fair value approach when specified criteria relating to risk mitigation are met, even when full retrospective application is not impracticable. So, yung pangalawang amendment naman po ay pinapayagan na po ng IFRS 17 yung entity na may information to apply a full retrospective approach to instead apply the fair value approach for a group of insurance contracts with direct participation features kapag na-meet po yung mga specified conditions sa risk mitigation. So, nami-meet po yung condition na ito if una, pinili po ni entity na i-apply yung risk mitigation option sa group prospectively from the transition date and pangalawa po, before the transition date, gumagamit na po ng derivatives reinsurance held or non-derivatives financial instrument measure at fair value through profit or loss si entity sa pag-mitigate ng kanilang financial risk arising from the group of insurance contract. The board noted that the entity that used the fair value approach avoid the situation in which changes in the fair value of risk mitigating instruments, for example, derivatives are reflected in opening retained earnings or equity while the corresponding changes in the insurance contracts are reflected in the contractual service margin. At the transition date, the fair value of the risk mitigating instrument will include only expectations about future cash flows. And in the fair value approach, the fair value of the insurance contracts at transition will also include only expectation about future cash flows. Next naman po is about the minor amendments. Meron din pong mga minor amendments dito. Yung mga minor amendments po na to, kinaklarify nila yung mga requirements po sa standards and nire-resolve po nila yung mga unintended consequences sa drafting. Yung mga minor amendments po na ito ay nakanote po sa amendment basis of conclusion of IFRS 17. So next naman po is about the effective date and transition daw po ng mga amendments. So the amendment to IFRS 17, and they are effective po for the annual period beginning on or after January 1, 2023 with earlier application permitted, and they are applied po retrospectively. And yung extension po of the temporary exemption from applying IFRS 9 amendments to IFRS 4, dinifer naman po nito yung expiry date ng amendment to annual period beginning on or after January 1, 2023. So, yung pangalawang amendment regarding sa IFRS 17 was dated December 9, 2021. Yung development naman po is amended by initial application ng IFRS 17 and IFRS 9 comparative information amendments to IFRS 17 to permit entities na unang nag-apply ng IFRS 17 and IFRS 9 at the same time to present comparative information about a financial asset as if yung classification and measurement requirement ni IFRS 9 had been applied dun sa financial asset before. Comments naman po regarding sa amendment is an entity that elects to apply yung amendment, i-apply niya po ito kung kailan niya po unang in-apply si IFRS 17. Yung International Accounting Standard Board or IASB, pinublish po nila yung initial application of IFRS 17 and IFRS 9 comparative information amendments to IFRS 17 with an amendment that allows companies na i-improve yung usefulness ng comparative information presented ng initial application ng IFRS 17 and IFRS 9. So before we discuss the key amendments here, let's take a look at the background of the amendment first. So marami pa daw po mga insurance companies ang hindi pa ina-apply ang IFRS 9 financial instruments, and i-apply pa lang po nila ito at the same time sa pag-apply po nila ng IFRS 17 insurance contracts. So pagsasabayin po nila. Kaso, magkaiba po yung requirements sa comparative information po ni IFRS 9 and IFRS 17 na kailangan pong i-present sa initial application nila. Sa IFRS 17 po, nire-require po niya si company na mag-present ng isang restated comparative period, while IFRS 9 po permits pero hindi po nire-require na magkaroon po ng restatement of comparative periods. And pinagbabawalan po ng IFRS 9 ang company na mag-apply ng IFRS 9 sa financial assets na din-recognize during the comparative period. So since then, meron pong mga insurers ang nag-raise po ng concern regarding sa usefulness po ng information na kailangan pong i-present for financial assets sa comparative period on the initial application po ng IFRS 17. So nasabi po nila na may mga information po na pwedeng maging misleading kasi pwedeng magkaroon po ng accounting mismatch na manggagaling po sa continued application po ng IAS 39 na hindi po magre-represent ng economic mismatch. And mahirap daw po itong i-explain. Kaya po, nangihingi po ng permission yung mga insurers po sa board na payagan po sila na mag-present ng significantly improved information about financial instruments na magre-result po sa pag-apply ng classification requirements ng IFRS 9 at the transition date po ng IFRS 17. And noong July 2021 nga po, nag-publish po ng proposed amendment to IFRS 17 sa IASB addressing po yung mga concerns na to. And na-finalize nga po itong amendment on December 9, 2021. So now, let us talk about the key amendments. Yung main amendment po sa initial application ng IFRS 17 and IFRS 9 comparative information amendments to IFRS 17 ay yung narrow scope amendment po sa transition requirement ng IFRS 17 for entities na i-apply po yung IFRS 17 and IFRS 9 at the same time. So the amendment regards po yung mga financial assets for which comparative information is presented sa initial application ng IFRS 17 and IFRS 9, pero hindi po nakarestate itong mga information na ito sa IFRS 9. Under the amendment, pinapayagan daw po si entity na mag-present ng comparative information about the financial asset as if yung classification and measurement requirement po ng IFRS 9 had been applied dun po sa financial asset na yon before. So, yung option daw po na ito ay available on an instrument-by-instrument basis. Sa pag-a-apply po ng classification overlay sa financial asset, hindi po required si entity na i-apply yung impairment requirements ni IFRS 9. Sa amendment po na ito, wala daw pong changes sa transition requirements sa IFRS 9. Sa effective date naman po ng amendment, kapag si entity daw po ay pinili niya na i-apply yung amendment, i-apply niya daw po ito sa initial application po ng IFRS 17. So, to better reflect changes in insurance obligation and risk, IFRS 17 requires an entity to update the fulfillment cash flow at each reporting date, using current estimates that are consistent with relevant market information. So next naman po is about sa commercial significance po ng mga amendments. So meron daw pong konting influence sa number ng affected entities kasi yung IFRS 17 po is a standard po siya for insurance contracts and hindi po siya standard for the industry itself or the insurance industry. Siyempre po, insurance companies ang pinaka-maapektuhan pero meron din naman pong ibang entities ang maapektuhan. Meron naman daw pong mataas na influence po sa mga affected entities kasi yung IFRS 17 po fundamentally changes yung accounting po para sa insurance contracts. Meron po itong substantial impact sa financial statements ng mga companies na merong insurance contracts. During IFRS 4 po kasi may huge diversity po ang pag-a-account ng insurance contracts and IFRS 17 harmonize those differences sa accounting practices and will transform po yung data, people, technology solutions, and investor relations. Mataas din daw po panigurado yung magiging implementation cost sa mga entities po na mag-i-implement po ng new standard. And to end po yung report namin regarding sa amendments in IFRS 17, here is a quote from IFRS 17. IFRS 17 solves the comparison problems created by IFRS 4 by requiring all insurance contracts to be accounted for in a consistent manner, benefiting both investors and insurance companies. So both the standard and its amendments are truly intended for the benefit of companies and their investors. And that's the end of our report on behalf of my group. Thank you.